Fundamental forecast for gold-neutral gold prices fell for the second consecutive week, with the precious metal down more than 2.1% to trade at $12.95 ahead of the New York close on Friday. The losses come on the back of FOMC interest rate decision, where Chair Yellen Company reaffirmed expectations for another rate hike in 2017 and announced the commencement of the balance sheet offload quantitative tightening starting next month. While the prospects for higher rates are likely to weigh on bullion prices, rising geopolitical tensions may limit the magnitude of the decline. The Federal Reserve released its fourth quarter projections this week, and although the committee did upwardly revise their year-end GDP forecast to 2.4%, they lowered inflation expectations, with core PCE personal consumption expenditure revised lower to just 1.5% from 1.7%. This was the second consecutive reduction we've seen in the Fed's inflation forecast, and continues to suggest the central bank remains uneasy with the continued softness in price growth. It's also worth noting that the interest rate dotplot suggests the Fed remains committed to one more hike this year. Expectations for the terminal or longer run rate were lowered, with the median forecast now calling for a nominal rate of 2.75%. The point is that, although markets did need to reprice the December, the end rate suggests the glide path will likely be even slower than expected. That said, look for United States dollars gains to be limited. From a technical standpoint, the prices do remain at risk near term, with the decline likely to offer favorable points of entry for the bulls. New to trading, get started with this free beginner's guide. A summary of IG client sentiment shows traders are net long gold. The ratio stands at 2.34. 70% of traders are long bearish. Reading long positions are 7.0% higher than yesterday and 6.6% higher from last week. Short positions are 0.6% lower than yesterday and 0.6% lower from last week. We typically take a contrarian view to crowd sentiment, and the fact traders are net long suggests spot gold prices may continue to fall. Traders are further net long than yesterday and last week, and the combination of current sentiment and recent changes gives us a stronger spot gold bearish contrarian trading bias. Learn how to use gold sentiment in your trading. Get more information on sentiment here. Free gold weekly. Gold prices reversed from basic slope resistance earlier this month, with the decline now testing the 2017 opening range high at $12.95. A weekly close above this threshold would give prices hope of a near-term rebound. Critical long-term resistance remains at $138,091. What makes a successful trader? Find out with our free ebook Gold Daily. Last week we highlighted that prices had set a clean monthly opening range just above basic trendline support, and we'll be looking for a break of this region for further guidance on the near-term outlook. A break early in the week kept the near-term focus lower in prices, with the decline taking gold back below the June highs. Interim support is at $12.81, backed by more and more significant confluence at $126,368. Key resistance near-term bearish invalidation stands at $13.25. A close above that threshold would be needed to mark resumption of the broader uptrend. Join Michael for his bi-weekly live webinar on the foundations of technical analysis. Register for free here. Gold 240 Min. A closer look at price action highlights gold prices continuing to trade within the confines of this well-defined descending channel formation. The break below the monthly opening range has us looking for a near-term low next week. That said, be mindful of rallies. SUB 1304 with a move lower targeting the aforementioned support targets. Bottom line, look for sideways to lower price action early next week, with a breach above channel resistance needed to suggest a larger recovery is underway. Written by Michael Boutros, currency strategist with Dalefx. Follow Michael on Twitter at Mforex. Contact him at boutros@dalefx.com or click here to be added to his email distribution list.